Part 1. Introduction to Trading for a Living. In the realm of modern finance, few titles have achieved the iconic status of Trading for a Living by Dr. Alexander Elder. This book is not merely a trading manual. It is a complete blueprint for building a career in the markets with discipline, structure, and psychological resilience. Rather than making exaggerated promises of overnight wealth, Dr. Elder presents a grounded and realistic approach. To trade well, one must first master the self, then the strategy, and finally the risk. Dr. Elder brings to the trading world a unique combination of experiences. He is a trained psychiatrist and a seasoned trader, and his ability to fuse psychological insight with technical precision sets this book apart from the crowd. His professional background allows him to diagnose not just market behavior, but the inner struggles of the individual trader. The emotional roller coaster of fear, greed, hope, and regret. These are not theoretical constructs, but daily battles that traders face, whether they acknowledge them or not. At the heart of trading for a living lies a powerful message. Success in trading is impossible without self-awareness and emotional control. Markets do not destroy traders. Traders destroy themselves by trading out of impulse, by refusing to take losses, or by chasing unrealistic gains. Elder confronts these realities with brutal honesty. He challenges readers to stop blaming the market and start looking inward. The greatest edge any trader can develop is not a system or a signal. It is a calm, disciplined mind. Once this foundation is set, the book transitions into technical analysis. But this is not a conventional catalog of patterns or indicators. Elder filters out the noise and focuses on what matters most: how to read price behavior, how to identify the direction of the trend, and how to interpret signals with logic and patience. He teaches a select group of tools: the moving average convergence divergence, MACD, the force index, and simple moving averages. That, when applied correctly, can provide clarity in the chaos of daily market moves. A core innovation Elder introduces is the triple screen system. This multi-timeframe analysis method forces traders to think in layers. The first screen identifies the dominant trend on a higher time frame. The second screen finds corrections on an intermediate time frame. The third screen drills down to the precise entry using short-term indicators. This layered structure helps filter out false signals and forces a more strategic, context-aware approach to execution. But even the most robust analysis is useless without proper risk management. Elder dedicates a critical portion of the book to this often neglected discipline. He lays down a simple but powerful rule: never risk more than 2% of your capital on a single trade. This single principle, if followed rigorously, can mean the difference between surviving a losing streak and blowing up an account. He emphasizes the importance of thinking in terms of probabilities, not certainties, and introduces the concept of expectancy, the mathematical expectation of your trading system over time. Elder's views on risk go beyond stop-loss placement. He teaches how to size positions, how to track drawdowns, and how to think like a portfolio manager rather than a speculator. He warns against overtrading, revenge trading, and emotional decision-making. For Elder, trading is a business, not a game, and that mindset shift is crucial. It means logging your trades, reviewing your performance, and constantly refining your edge. What makes trading for a living a lasting resource is not just its content, but its structure. The book does not hand you a formula. It teaches you how to build your own, one that fits your time, your personality, and your tolerance for risk. It is both principled and flexible, suitable for traders across all markets, from equities and futures to Forex and crypto. Perhaps most importantly, Elder deconstructs the myths and illusions that trap new traders. He exposes the dangers of trading based on hope, the fallacy of doubling down on losses, and the illusion of certainty in predicting market movements. He reminds readers that successful trading is not about being right all the time. It is about managing risk and letting probability work in your favor over a long series of trades. In essence, trading for a living is a masterclass in trading discipline. It builds the mindset of a professional. It lays the foundation for strategic thinking. It prepares you for the mental and technical challenges of a career in trading. And above all, it arms you with the tools to survive in a world where most fail, not because they lacked knowledge, but because they lacked structure, self-control, and a plan. For anyone who wants to treat trading not as a hobby, but as a serious long-term profession, this book is a must-read. It does not sell a dream. It teaches how to build one through clarity, consistency, and character. Part 2. Trading Psychology. In the world of trading, technical analysis may get the spotlight, and market indicators may claim precision. But beneath every trade lies a deeper force: human psychology. Dr. Alexander Elder begins trading for a living not with a chart or a formula, but with a mirror. Before one can master the market, one must first confront the self. This is not motivational fluff. It is a hard truth forged in losses and verified by decades of observation. Most traders do not fail because they lack knowledge. They fail because they cannot manage their emotions. The market is a battleground, but the real war is internal. Fear, greed, hope, overconfidence, denial. These are not abstract concepts. They are daily experiences for every trader. A person may read all the books, build a sophisticated system, and have access to the latest technology. Yet none of it matters if they lack emotional control. As Elder famously outlines, you are the weakest link in your trading system. Fear paralyzes. A trader who hesitates to act on a valid signal often misses the move entirely. But fear can also push one to cut profits too early, escaping a trade prematurely before it has a chance to work. On the other hand, greed blinds. It fuels overtrading, poor risk-taking, and an illusion of control. A trader may ignore rules in the hope of a bigger gain, only to watch a winning trade reverse into a loss. Then there is hope, the most dangerous emotion in trading. It keeps a trader locked in a losing position, refusing to admit error. Hope whispers that the market will turn, that things will get better, that a small loss is not real until it is closed. Elder makes it clear: professional traders do not hope. They plan, they act, and they accept losses as part of the business. Self-discipline, according to Elder, is the cornerstone of successful trading. It is not enough to know what to do. One must do it. This requires emotional distance, routine, and a framework for decision-making. Discipline means setting a stop-loss and not moving it. It means not entering a trade out of boredom or revenge. It means respecting your own trading plan, especially when it is uncomfortable to do so. Elder explores the concept of the inner trader, the psychological self that influences every decision on the screen. Many traders carry emotional baggage into their trades: fear of failure, a need for excitement, a desire for redemption. Without awareness of these impulses, a trader is not in control. The market becomes a stage for unresolved inner conflicts. He also addresses addiction. For some, trading becomes a substitute for gambling. The thrill of risk becomes more important than the outcome. The process overtakes the objective. Elder warns that when trading serves an emotional need rather than a financial goal, disaster is inevitable. He draws from his psychiatric background to explain how traders can recognize these dangerous patterns and escape them through awareness, structure, and accountability. To combat emotional sabotage, Elder recommends creating a trading diary. This is not simply a record of trades, but a tool for self-analysis. The diary should capture not just price levels and outcomes, but the trader's thoughts, feelings, and decision-making logic. Over time, patterns emerge. You begin to see when you are most prone to error, perhaps after a big win or during a stressful personal period. This kind of feedback is impossible without reflection. The diary becomes a psychological mirror. Routines are another defense against emotional chaos. Elder emphasizes the power of habits. Starting each trading day with a consistent routine, market analysis, reviewing overnight news, checking key indicators, creates a sense of control. Ending the day with a trade review reinforces discipline. This kind of structure is not glamorous, but it is vital. Professionals rely on routine, not adrenaline. A trader's identity is another key theme. Many beginners tie their self-worth to their trading results. A win makes them feel smart. A loss makes them feel inadequate. This attachment creates a toxic cycle of emotional highs and lows. Elder teaches that a trader must separate the self from the outcome. One trade does not define you. Your process, discipline, and long-term results do. To further stabilize emotions, Elder encourages traders to avoid overexposure. Risking too much capital on a single trade magnifies stress. With proper position sizing, even a loss becomes manageable. When the financial impact is controlled, emotions become easier to manage. A small, planned loss is just part of doing business. not a personal failure. Another concept Elder discusses is the psychological danger of success. Ironically, many traders lose discipline after a big win. Confidence becomes overconfidence. They increase position size. They abandon rules. They chase excitement. The result is often a painful drawdown. Elder warns that success must be handled with as much care as failure. The greatest risk comes not when you are struggling, but when you believe you cannot lose. Elder's writing dismantles the myth of the natural-born trader. He believes that trading is a skill, like surgery, law, or flying a plane. It must be learned, practiced, and mastered over time. The emotions you feel are not weaknesses. They are human. What matters is how you manage them. The difference between a professional and an amateur is not the absence of emotion, but the ability to act with discipline despite emotion. The ultimate message of this section is simple yet profound. If you want to trade for a living, you must master your own psychology. No system, no indicator, no software can do it for you. The path to consistent profitability begins in the mind. Master your emotions, and you will give yourself the chance to survive. Align your actions with your plan, and you give yourself the opportunity to succeed. Part 3. Technical Analysis. In the financial markets, technical analysis is often misunderstood. To many, it appears to be a collection of abstract lines, patterns, and mathematical indicators that promise to predict the future. But in Trading for a Living, Dr. Alexander Elder clarifies a deeper truth. Technical analysis is not about fortune telling. It is a framework to study mass psychology, to measure momentum, and most importantly, to manage risk. Technical analysis is the art of reading the crowd through price action. Every candle on a chart reflects a battle between buyers and sellers. Every breakout, pullback, and reversal is a manifestation of human behavior: fear, greed, impatience, conviction. Elder teaches that the chart is your window into collective decision-making. It shows you what others have done, not what they will do. But within that behavior lie repeatable patterns that, when studied with logic and discipline, can provide high-probability opportunities. Rather than obsessing over dozens of indicators, Elder urges traders to simplify. He focuses on a small toolkit of technical instruments, each chosen for its clarity, reliability, and ability to reflect market psychology. These include moving averages, the moving average convergence divergence, MACD, the force index, trend lines, and support resistance levels. For Elder, each tool must serve a specific function. Indicators should not overwhelm the trader with noise. They should confirm what price action already suggests. At the heart of Elder's approach is trend analysis. Every trader must first determine whether the market is trending or ranging. In a trending environment, traders look for pullbacks in the direction of the prevailing trend. In a sideways market, they seek reversals near established support or resistance. Without clarity on trend, all other signals become meaningless. Elder emphasizes the importance of defining trend direction on higher timeframes before engaging with shorter-term setups. One of the most effective tools in Elder's system is the MACD. This indicator, based on the difference between exponential moving averages, helps identify momentum shifts and trend confirmations. Elder does not use it to predict tops and bottoms. He uses it to gauge the strength and health of a trend. A rising MACD line above zero suggests strong bullish momentum. A declining MACD below zero warns of weakness in a downtrend. Divergences between MACD and price can hint at potential turning points, but they must be confirmed by other elements. Another signature tool in Elder's arsenal is the force index. Developed by Elder himself, this indicator combines price movement, direction, and volume into a single line. It helps traders evaluate how powerful a move really is. A price breakout with low volume is weak. A breakout accompanied by a surging force index is much stronger. The force index allows traders to assess whether the crowd is acting with conviction or hesitation. Elder also advocates for the use of moving averages, not as magical signals, but as filters. They help smooth out short-term noise and define the underlying direction of the market. A price trading above a rising moving average is considered to be in an uptrend. A crossover, especially when confirmed by momentum indicators, can signal a shift in trend. Moving averages also act as dynamic support and resistance in trending markets. But indicators alone are not enough. Elder insists that every technical signal must be viewed in context. A MACD crossover near a resistance level carries a different weight than the same crossover in open space. A force index spike after a breakout is more meaningful than one occurring within a range. Technical analysis is not mechanical, it is interpretive. It requires the trader to synthesize information, not simply follow it. To bring structure to this process, Elder introduces the triple screen trading system, one of the most elegant multi-time frame strategies in modern technical analysis. The system involves three stages, or screens, each serving a unique role. 1. First screen, trend identification. The trader begins by analyzing a longer time frame, for example, the daily chart if trading intraday, to identify the dominant trend. This ensures that any trade is taken in alignment with broader market forces. 2. Second screen, short-term counter-trend moves. On an intermediate time frame, such as the hourly chart, the trader looks for short-term moves against the major trend, pullbacks that could offer entry points. Oscillators like the stochastic or relative strength index, RSRSI, are useful here to detect temporary overbought or oversold conditions. 3. Third screen, timing the entry. The shortest time frame, perhaps the 15-minute chart, is used to time the precise entry, often through breakout methods or momentum triggers. The goal is to enter with confirmation and minimal lag. This layered approach reduces false signals and forces the trader to view the market from multiple perspectives. It reflects Elder's broader philosophy: trade with structure, not impulse. Elder warns against overfitting and indicator addiction. He notes that many traders fall into the trap of constantly searching for the perfect combination of tools. In doing so, they become reactive, not analytical. The role of technical analysis is not to remove uncertainty, but to frame risk. A good trade setup is not one that guarantees success, but one that offers favorable odds and a defined exit. The final and often overlooked component of Elder's technical approach is volume analysis. Price is important, but volume tells the story behind the price. A breakout without volume is often a trap. A reversal with heavy volume can signal institutional action. Volume spikes often precede trend changes or signal climaxes. Elder encourages traders to read volume patterns in tandem with price action and indicators. Ultimately, technical analysis is a language. It is how the market communicates. Elder trains traders to read that language, not to predict with certainty, but to make informed decisions under uncertainty. He teaches that the best traders are not those who chase signals, but those who observe patiently, interpret thoughtfully, and act decisively when the odds are favorable. As in all parts of Elder's framework, the goal of technical analysis is not to be right on every trade. It is to build a system where winners are larger than losers, where emotions are controlled by logic, and where decisions are made based on repeatable principles. In the long run, consistency beats brilliance. Part 4. Building a trading system. One of the greatest fallacies in trading is the belief that success lies in discovering a secret formula, a magic indicator, or a holy grail strategy. In Trading for a Living, Dr. Alexander Elder dismantles this myth with precision. He teaches that a successful trading system is not something you find, it is something you build. And it must be constructed with logic, tested with data, and executed with discipline. A trading system is not just a collection of indicators or entry signals. It is a complete framework, a decision-making architecture that defines when to act, how much to risk, where to exit, and when to stand aside. Elder emphasizes that a true trading system must be aligned with your psychology, your risk tolerance, your lifestyle, and your time horizon. There is no one-size-fits-all. What works for one trader may destroy another. The foundation of any solid trading system begins with entry criteria. These criteria should not be vague or subjective. They must be clearly defined and based on observable market behavior. Elder encourages traders to select a few reliable technical tools, perhaps a moving average crossover, a MACD divergence, or a breakout confirmed by volume, and to build entry rules around them. The goal is not to capture every move, but to enter only when the odds are favorable and risk is measurable. But entry is only the beginning. Without an exit strategy, even the best entry can turn into a disaster. Elder separates exits into two types: protective stops and profit targets. A protective stop defines the maximum acceptable loss on a trade. It should be placed based on technical logic, such as a break of support or violation of a trend line, not emotion. Profit targets, on the other hand, define a rational area to close a trade based on prior resistance, measured moves, or momentum exhaustion. Elder cautions against relying on intuition or improvisation once a trade is live. The market is emotionally charged, and real-time decisions are often clouded by fear or greed. A well-defined system removes the need to think in the heat of the moment. It provides clarity when emotions rise. This is why every component of the system must be written down, tested, and rehearsed until it becomes second nature. Another core element of a trading system is position sizing. Even the best trades can destroy a portfolio if the size is too large. Elder teaches that risk per trade should never exceed a small percentage of your total capital, often 2% or less. This ensures that no single trade, regardless of its outcome, can significantly damage your account. Proper position sizing is the bridge between opportunity and survival. A robust trading system also includes rules for market conditions. Not every system works in every environment. A trend-following system will struggle in choppy sideways markets. A mean reversion approach will fail during strong directional moves. Elder urges traders to identify the type of market their system is built for and to stay on the sidelines when conditions are not favorable. This selective engagement is often the difference between consistency and chaos. To refine a system, Elder advocates for two critical processes: backtesting and forward testing. Backtesting involves applying your system to historical data to evaluate its effectiveness. It reveals win rates, average returns, drawdowns, and expectancy. But it also exposes flaws: overfitting, late entries, poor exits. Elder warns that backtesting must be realistic. Trades should include slippage, commissions, and missed fills. Fantasy testing leads to disappointment. Once a system performs well in backtesting, it must be forward tested, run in real time with paper trades or small capital. This allows the trader to see how the system behaves under current market conditions. It also builds confidence and discipline. Forward testing is not just about results. It is about developing trust in your system's logic, even when trades lose. Elder reminds traders that a system is only as good as your ability to follow it. Another overlooked component of a trading system is the psychological fit. A system that requires constant monitoring may be ideal for a full-time trader, but exhausting or disruptive for someone with a day job. A system with wide stops may be statistically sound, but emotionally intolerable for a risk-averse personality. Elder emphasizes that your trading system must suit you. Otherwise, you will abandon it under stress, no matter how effective it is. To help traders personalize their systems, Elder encourages the use of a trading journal. This journal is more than a trade log. It is a laboratory. It tracks setups, entries, exits, emotions, observations, and lessons learned. Over time, it reveals what works, what fails, and what patterns emerge. The journal becomes the blueprint for continuous improvement. Systems evolve, and so should the trader. Once the system is defined, tested, and aligned with your personality, the final step is execution. Elder insists that rules are worthless unless followed. Discipline is the real edge. The market will test your patience, tempt you to deviate, and punish inconsistency. The professional trader resists. He follows the plan, not because it guarantees success, but because it manages risk and stacks probability in his favor. Ultimately, a trading system is not about being right on every trade. It is about creating a repeatable process that produces positive results over a series of trades. It is a structure that frees you from emotional noise and reactive decisions. It is the difference between gambling and operating a trading business. As Elder writes, amateurs look for excitement. Professionals look for structure. And that structure begins with a system. A system that you understand, believe in, and can execute with confidence and consistency. Without it, you are not trading. You are guessing. But with it, you take the first real step toward trading for a living. Part 5, Money Management. No matter how accurate your entries are, how well-timed your exits, or how advanced your indicators, your trading career cannot survive without proper money management. In Trading for a Living, Dr. Alexander Elder makes one truth abundantly clear. It is not the market that takes traders out of the game. It is their inability to manage risk. Money management is not merely about protecting capital. It is about ensuring long-term survival. It provides the mathematical and psychological foundation for consistency. Elder argues that most traders lose not because their ideas are bad, but because they bet too much when they are wrong and too little when they are right. Risk is not something to be feared. It is something to be calculated, controlled, and respected. The first and most critical principle in Elder's framework is what he calls the 2% rule. This rule dictates that no single trade should risk more than 2% of your total account equity. Not just the capital committed to the trade, but the actual risk. The distance between your entry and stop loss multiplied by the number of shares or contracts. This ensures that even a string of losing trades will not threaten your account's viability. Why 2%? Because trading is a probability game. Even the best systems experience losing streaks. A trader risking 10% or more per trade may not survive a few bad decisions. But one who risks 2% or less can endure adversity and still remain in the game long enough to allow probability to work in their favor. Elder emphasizes that your most valuable asset is not your strategy, it is your staying power. Beyond the individual trade, Elder discusses overall portfolio exposure. Many traders fall into the trap of correlation. They may think they are diversified by holding several positions, but if those assets move together, the risk is concentrated. For instance, being long 3 tech stocks is not diversification. It is a leveraged bet on the tech sector. Elder urges traders to measure risk not just per trade, but across the entire portfolio. He also introduces the concept of drawdown control. A drawdown is the decline from a peak to a trough in your equity curve. While some drawdown is inevitable, uncontrolled drawdowns erode capital and confidence. Elder encourages traders to set maximum drawdown limits, points at which they pause trading, reassess their system, or reduce position size. A drawdown of 10% is manageable. One of 25% requires a 33% gain to recover. At 50%, the climb back becomes nearly impossible. Another key theme is the concept of risk-to-reward ratios. Elder teaches that every trade must offer a favorable relationship between potential gain and potential loss. A common minimum threshold is a 2-to-1 reward-to-risk ratio, risking $1 to potentially gain 2. This ratio ensures that even with a win rate below 50%, the system remains profitable. Elder stresses that before entering any trade, the trader must calculate the potential upside, the downside, and the probability of each. Only trades that meet the criteria are worth taking. These ideas culminate in the concept of expectancy, a mathematical formula that combines win rate, average win, and average loss to calculate the expected return per trade. A system with positive expectancy, applied with discipline and proper risk control, is the hallmark of professional trading. Elder teaches that expectancy is not a guarantee. It is a framework to evaluate whether your trading process has an edge over time. Elder also warns against the illusion of control that comes with overtrading. Many traders believe that being constantly active equates to being productive. In reality, overtrading leads to burnout, poor decision-making, and elevated risk. A trader who respects money management trades selectively. They wait for high-probability setups and only commit capital when the odds are aligned. Patience, Elder reminds us, is not passive, it is strategic. He discusses the role of position sizing, the science of adjusting trade size based on volatility, confidence, or account equity. One method Elder explores is the fixed fractional method, in which the trader adjusts size to maintain the same percentage risk across different instruments or market conditions. A volatile stock may require fewer shares than a stable one. A highly confident setup may justify slightly larger exposure, provided it remains within overall risk limits. Position sizing is not just a mathematical tool. It is a psychological stabilizer that prevents emotional overreaction. Elder draws a powerful parallel between trading and business. No successful enterprise risks its entire capital on a single project. A good business controls costs, evaluates risk, and budgets for uncertainty. Traders must adopt the same mindset. Each trade is a business decision. It has a cost, a potential return, and a calculated risk. The trader is the manager, and the account is the enterprise. Without structured money management, the business fails, even if the product is good. He also highlights the psychological impact of losses and the danger of revenge trading. After a losing trade, many traders attempt to win it back quickly, often by doubling risk or abandoning rules. This behavior compounds losses and leads to emotional spirals. Elder teaches that the only way to recover from a loss is through rational, methodical execution, not emotional retaliation. The emotional dimension of money management is perhaps its most underrated aspect. Knowing your capital is protected gives you the freedom to trade with clarity. It allows you to sit through normal drawdowns without panic and to resist the temptation of impulsive risk taking. Money management is not just a defense mechanism, it is the engine of confidence. In summary, Elder's approach to money management is both practical and philosophical. It is rooted in mathematics, but designed to serve psychology. It is not about being conservative, it is about being strategic. The trader who respects risk controls their destiny. The one who ignores it, even with the best strategy, eventually loses everything. In trading, there will always be uncertainty. There will always be losing trades. But with disciplined money management, you can survive the losses and position yourself for the wins. As Elder concludes, profits make you feel good, but risk management keeps you in the game, and staying in the game is the only way to win. Part 6, Trading as a Business. Trading may be executed through a keyboard, but it must be managed like a company. In the final part of Trading for a Living, Dr. Alexander Elder reframes the role of the trader, not as a gambler, speculator, or even investor, but as a business owner operating in a highly competitive environment. This shift in identity is not cosmetic. It redefines the way a trader approaches every aspect of the craft, from strategy and risk to planning, discipline, and review. Every legitimate business begins with a business plan, and Elder insists that trading must be no different. A professional trader outlines their edge, their tools, their goals, and their capital deployment rules with the same level of seriousness that a company would bring to launching a product. A trader without a plan is a ship at sea with no compass, vulnerable to every emotional storm and market ripple. In Elder's vision, the trading plan is more than a list of entries and exits. It includes clearly defined strategies, risk parameters, trading schedules, and specific criteria for evaluation. It answers critical questions. What will you trade? When will you trade it? What tools and indicators will guide your decision-making? What is your daily risk limit? What will cause you to stop trading and reassess? Without these answers, consistency is impossible. Another hallmark of a business-like trader is record keeping. Elder introduces the trading journal as a vital component of professional performance. Just as a company audits its operations, a trader must review every trade, not just the outcome, but the reasoning behind it. A proper journal includes entry and exit points, position size, emotional state, market conditions, and post-trade reflections. Over time, this becomes a goldmine of insight, revealing patterns in both behavior and strategy that can be refined. The trading journal is not a punishment. It is a mirror. It reveals strengths, exposes weaknesses, and builds accountability. Elder emphasizes that most traders lose not because they lack intelligence or skill, but because they do not take the time to learn from themselves. The act of journaling transforms trading from reactive to proactive. Just as businesses invest in their infrastructure, a professional trader must invest in education and development. Elder views continued learning as essential. Markets evolve, technology changes, and new strategies emerge. Traders who treat their profession seriously attend seminars, read widely, test ideas, and evolve with the environment. They do not chase holy grails, they refine edges. Another business principle Elder emphasizes is cost control. Trading fees, slippage, and platform expenses may seem minor, but they add up. Just as a business watches its overhead, a trader must be aware of these hidden drains. More importantly, poor discipline leads to the largest hidden cost: unnecessary losses. Every undisciplined trade is an expense. Every deviation from the plan is a cost to the business. Performance evaluation is central to the business mindset. Companies review quarterly results, measure performance indicators, and adjust strategy. A trader must do the same. Elder encourages traders to review weekly and monthly performance, looking not just at profits, but at execution quality. Did you follow your rules? Did you manage risk appropriately? Were your entries and exits aligned with your system? Profit and loss are important, but process consistency is what determines longevity. Professional traders also set realistic goals. Inexperienced traders often expect rapid riches. Elder dismantles this myth. In a business, profitability is built over time with consistent execution and measured risk. A trader who seeks to double their account in a week is no different than an entrepreneur expecting their startup to become a Fortune 500 company overnight. Unrealistic expectations breed disappointment, recklessness, and failure. One of the most overlooked aspects of trading as a business is the emotional management system. In most professions, individuals are removed from the financial consequences of their actions. A salary or hourly wage buffers mistakes. But in trading, every decision has an immediate financial result. This creates intense emotional pressure. Elder teaches that managing one's emotional capital is just as important as managing financial capital. Emotions like fear, greed, hope, and anger can destroy a business from within. Therefore, the business-like trader develops routines, boundaries, and recovery practices. This might include stepping away after a losing streak, reducing position size, engaging in mindfulness or rest, and maintaining work-life balance. Just as a healthy executive is vital to a company's success, a psychologically stable trader is critical to their own performance. Dr. Elder introduces the concept of treating trading days like business shifts. You show up at a set time, you focus, you execute, you take breaks, you end the day with review and reflection. This structure replaces the chaos of impulsive behavior with the discipline of professionalism. You do not need to be active every minute. You need to be prepared, present, and purposeful. Capital allocation also mirrors business thinking. A business does not invest all its resources into a single client or project. It diversifies, allocates budgets, and protects against downturns. Likewise, a trader must segment capital, not just across positions, but in terms of risk tiers. Some strategies may warrant higher allocation due to proven reliability. Others are experimental and require smaller exposure. Elder also stresses the separation of personal and trading finances. Just as a business maintains its own accounting, so should a trader. Mixing household needs with trading funds distorts decision-making. A professional keeps trading capital separate, tracks performance independently, and evaluates the trading business on its own merits. One of Elder's final insights is that running a successful trading business requires detachment from results. That does not mean apathy. It means you do not let short-term wins or losses dictate your identity or process. A business does not shut down because of one bad day. It adapts, learns, and moves forward. The professional trader does the same. Consistency, not intensity, is the key to sustainability. Ultimately, trading for a living is a discipline, not a dream. It is not about freedom from a boss or working from a beach. It is about showing up every day with a system, a plan, and a mindset rooted in professionalism. Elder's final message is that when you treat trading as a business, you gain not just profit potential, you gain control. You control your process, you control your risk, and most importantly, you control your future. Part 7. Final warnings, traders' traps, and the last word: success in trading is not determined only by the systems you use or the indicators you follow. It is often dictated by the traps you avoid. In this final section, Dr. Alexander Elder offers a series of cautionary lessons, warnings based not on theory, but on the hard-earned failures of traders who came before you. These traps are timeless. Whether you trade stocks, futures, options, or crypto, you will face them. Your ability to recognize and sidestep them may be the only thing standing between long-term success and financial ruin. Trap 1. Overtrading. One of the most dangerous mistakes is overtrading. It happens when you feel the need to be constantly in the market, clicking buttons, chasing action. The market rewards patience, not hyperactivity. Overtrading drains emotional capital and piles on commission costs. Many traders fail not because their strategy is flawed, but because they take too many unnecessary trades. A real professional sits out when the edge is not present. Trap 2. Revenge trading. Losing is part of trading, but seeking revenge is not. The market does not care about your emotions. If you try to win back losses by increasing size or forcing trades, you are no longer trading. You are gambling. This trap ruins accounts, confidence, and careers. The only cure is discipline and a written plan that stops you from self-destruction. Trap 3. Abandoning the stop. Every beginner swears they will use stop losses. But under stress, many move them, widen them, or delete them altogether. This single decision can lead to a catastrophic loss. Stops are not a suggestion, they are a business rule. Breaking them is like a pilot ignoring instruments during a storm. If you cannot follow your own stop, you are not trading, you are wishing. Trap 4. Unrealistic expectations. Many enter the market hoping to double their account in 1 month. They dream of quitting their job next week. This fantasy mindset causes traders to take oversized positions, ignore risk, and fall for scams. Real trading is slow, methodical, and full of lessons. Expect to learn for months or even years before becoming consistent. Trading is a career, not a lottery. Trap 5. Blindly following gurus. The internet is filled with self proclaimed experts offering signals, magical indicators, or private groups promising riches. Many of these gurus have never traded real money. They sell dreams, not results. Dr. Elder urges traders to take responsibility for their decisions. Follow no one blindly. Test everything. Think for yourself. That is what separates professionals from sheep. Trap 6. Lack of review. A trader who does not review their trades is like an athlete who never watches game footage. Without reflection, there is no improvement. The journal is your teacher. It shows you what works and what does not. Skipping this step leads to repeated mistakes. Review is not optional. It is part of the job. Trap 7. Trading without passion or purpose. Many are drawn to trading because of the potential money. But if you hate the process, if you are bored by studying charts, understanding psychology, and tracking performance, you will not last. Trading is not for everyone. The grind, the losses, the uncertainty, these are real. If you do not love the craft, you will burn out fast. Final words. Trade like a professional. Think like a business in trading for a living. Dr. Elder has taken you through psychology, technical analysis, system building, risk management, and professional discipline. But none of it will matter unless you treat this as a business, not a hobby. You are not here to gamble. You are here to build something, slowly, wisely, consistently. The markets do not owe you anything. They reward clarity, discipline, and self-control. Your edge is not in finding the perfect indicator. It is in mastering yourself. Most people will never make it in trading, not because they lack tools or talent, but because they never become students of the game. They never respect risk. They never stop chasing shortcuts. Do not be like them. Build your edge, honor your stops, review your trades, respect the process, stay humble, and remember, every loss is a lesson, every win is a responsibility, and every trade is a mirror. Join the movement. Subscribe to Trading Mindset Lab. If this message speaks to you, if you are tired of hype and hungry for truth, if you want to train your mind before you risk your money, then join us at Trading Mindset Lab. We dive deeper into everything Dr. Elder teaches: discipline, system building, emotional control, and professional execution. No shortcuts, no nonsense, just real tools to help you survive and grow in the world's toughest business. Subscribe now. Sharpen your edge. Trade with clarity. Your journey does not end here. This is where it really begins.